Hi, this is Kevin Kerr for Money and Markets TV. The US dollar is still the most powerful currency in the world, but it's already falling from grace. Its collapse won't happen overnight, though. It's a long and painful process driven by bad judgment, irresponsible fiscal policies, and arrogance. We know this because it has happened before to the world's most powerful currency. Roman emperors debased their currency in order to supply a demand for more coins. The result was widespread severe inflation and instability, which we can see by looking at the content of silver in the coins versus the wages of Roman soldiers. This inflation, along with extreme taxation, helped cause the collapse of the mightiest empire the world had ever seen. And the same thing could happen to the United States. One modern-day example of inflation run amok is the African nation of Zimbabwe. That country even issued $100 trillion notes, and inflation reportedly reached 231 million% at the height of the disaster. But the main cause of hyperinflation, whether in Rome, Zimbabwe, or the United States, is always the same: a massive and rapid increase in the amount of money in a system that is not supported by growth in the output of goods and services. In other words, it's the nation's monetary authority irresponsibly borrowing money to pay its expenses and obligations. Hyperinflation results in an imbalance between the supply and demand for money, including currency and bank deposits. Eventually, a complete loss of confidence in the money is almost inevitable. The public panics, and global market participants dump the currency. In our case, arrogance is also playing a role in causing inflation. Federal Reserve Chairman Ben Bernanke has said over and over that the United States can always just print more money as needed. So, as the powers that be grapple over how to raise the debt ceiling, the money pit is sinking deeper and deeper. Prices for most everything we buy, especially food and energy, are soaring. And it seems the dollar loses more and more ground every day. Indeed, the dollar is skating on thin ice. Already, many nations are shifting out of dollars and into gold and other forms of hard assets, or even instituting barter systems. Most recently, China and Iran have forged a deal to barter oil for goods. OPEC has also repeatedly discussed trading oil in another currency instead of dollars. In fact, OPEC members have called for a fully convertible gold-backed dinar for oil sales instead of US dollars. A move like that would shake the very foundation of the dollar. So, what can investors do to protect themselves from hyperinflation and a collapse in the dollar's buying power? Here's my 3-step action plan. Step number 1, reduce your dollar holdings. Move into precious metals, gold, silver, or both. Step number 2, once you've made the decision to add precious metals to your portfolio, do it in a diverse way. Some physical gold and silver bars are good. Coins are good too, if you know how to buy them. Step number 3, in addition to physical gold and silver, you may want to add key ETFs. I prefer ETFs that are backed by physical gold and silver. 5 of these are the SPDR Gold Shares, the iShares COMEX Gold Trust, the ETFS Physical Gold Shares, the iShares Silver Trust, and the ETFS Physical Silver Shares. But I like ETF options even better. They offer you leverage and a bonus, limited risk. They're the tool I use to help my Master Trader members seek gains in any major asset class in the world: stocks, precious metals, commodities, bonds, and even foreign currencies, no matter what event or trend is happening in the world. The bottom line is that the risk to the dollar is real. Investors must take control of their destiny or face seeing their wealth disappear along with the once mighty greenback. I'm Kevin Kerr for Money Markets TV. Thanks for watching.